Okay, hello everybody. It's just gone 5:30, so I'm going to go ahead and get started. This is being recorded, so for anyone that needs to drop off or for those who join late, they can kind of go back and rewatch. So to get started, I will talk a little bit about who I am, what Finasana is, and then we will jump right into it. There will be time at the end for a Q&A. So if you have any questions, feel free to either hold them till the end to see if I cover it throughout, or just go ahead and drop them in the chat. And if I see it, I'll try to get to it during the presentation. Otherwise, we will go through it at the end. There is going to be a discount code at the very end for everyone to access the platform. So if you can, highly recommend staying till the end. It will be well worth it. So Finasana is a financial wellness and education platform that's on a mission to make money easier and close the financial advice gap. What we mean by closing the financial advice gap is that today it is quite difficult for anyone to just get financial advice. It's expensive, there's a lot of barriers, and it's really reserved for those who either grew up getting proper financial education and literacy tools, or those wealthy enough to hire a financial advisor. Now, there's more and more things online these days, and it's becoming easier to properly educate yourself. Finasana is a place that you can go to get all of the information that you need. We're on a mission to teach people how to invest their money, manage their finances, build a budget that isn't going to be restrictive, isn't going to be boring, but most importantly, do this all in a way that is relatable, in a way that isn't excruciatingly boring, in a way that people are actually going to want to listen to and want to manage their finances better, because it's going to be fun and it's going to result in you improving your life as a result of this, and not just some boring financing jargon. So a little bit of history. I'm Gabby Slemmer, the founder of Finasana. We launched last year as a web platform and mobile app for both Apple and Android. Prior to launching Finasana, my background was in corporate finance. I worked at an investment bank and as an investment professional at a hedge fund, so doing a lot of corporate high-level finance. But when we think about the type of finance that's going on kind of on Wall Street at businesses investing, and the type of investing that we do as individuals, it's actually not that different. I mean, the amounts are quite different and the scale at which it's done is obviously very different, but the underlying concepts are the same, and they can apply to all of us to build a good investment strategy and prepare ourselves for the future. A little bit more about me. I'm also a yoga teacher, which might seem completely out of left field, but the point in telling you that is because it's integral to the foundation of Finasana and our approach to money being linked with wellness. So I would say that Finasana is where Wall Street meets wellness. We take a mindful approach to money. It's not all about doing spreadsheets and making sure your tax strategy is the most maximized. Rather, it's about learning how to deal with your finances in a way that's going to reduce stress, improve mental health, make you happier, not make you worry about money, and let you live the life that you want, both today and in the future. We've been guest speakers at various universities, various associations, featured in some fun publications. And today, actually, we just released the first episode of our brand new podcast, Invest Like a Woman. So I definitely recommend you go check that out. On the website and the app itself, we offer masterclasses where we have more than 20 different lessons on personal finance topics, ranging from how to stress less about money, how to build a budget, and of course, my personal favorite and why all of you are here today, how to invest in the stock market. On the app, we also have Ask Finasana and one-on-one coaching, which allows you to get more personalized guidance, more one-on-one, ask your questions, get them answered, kind of like in office hours, if you will. And then workshops such as the one that you are listening to today. So let's just start off talking about why investing is important. Your decisions today will impact your future. And it's not about saving 90% of your income so that you can retire early. Rather, it's about balancing those decisions and those choices, financial or otherwise, with your long-term goals to maximize your happiness and your choices in life, both today and 10, 15, 20 years from now, more than that. So this is just a little graph that is here to kind of represent different stages of our life. So early in your career is when you start earning money. Most of us are going to spend most of it, a lot of it. But it's really crucial to start thinking about managing your finances, investing your money early on, because the amounts that we save early on in our lives and our careers are going to have an outsized impact later on. And that's not to say you can't start at any age, but it's just to reiterate the importance of starting early. Mid-level of your career, you're kind of getting a little bit older. At this stage, it's about finding the balance between having a good long-term strategy while still being able to enjoy yourself in the present. So the earlier that you start managing your finances, the more flexibility you're going to have both in midlife and later life. And then in retirement is where we can enjoy the benefits of our decisions earlier in life, but hopefully before then too. So the goal is to live off of any passive income. We don't have to work anymore. We can watch our investments continue to grow and spend the money that we've worked so hard for. So before we move on to the more investing bit, I'm going to touch upon 3 rules for money that if you take nothing else away from this presentation, but remember these 3 rules and apply them, I'll consider that a resounding success. Now, these are going to sound incredibly basic to some of you. A lot of you will probably roll your eyes and say, oh, I didn't need to join an introduction to investing webinar to hear these, but hear me out because they are so incredibly important. And a lot of times we end up making mistakes, losing our footing on these really small things, these habits that we aren't following consistently enough. It's not huge things that often cause us to get into kind of precarious financial situations. It's a lifetime of bad habits. So if you can implement these 3 things, you're going to be way ahead of the curve. So the first one is save money. Start early, be consistent, save something. You might have heard the expression pay yourself first. Really, really important. As long as you're saving a little bit out of each paycheck, then over time it will add up. The second is get rid of bad debt. I'm going to talk a little bit what I mean by this, but for the most part, bad debt is consumer debt, credit cards, payday loans, student loans if you're in the US, and pretty much any other debt that isn't mortgage debt. And then number 3, invest for the future. Now, number 2 and number 3 are really predicated on number 1. If you're saving money, you can invest it or put it towards paying off bad debt. Now, the purpose of this presentation is investing. So that's what we're going to focus on. And for the rest of the presentation, the next 30 to 40 minutes, like I said, I'll leave some time at the end for questions. So for the next about 30 minutes, this is what we're going to talk about. We'll first debunk some common investing myths. We'll talk a little bit more about why it's so important to invest your money, steps that you need to actually take to become an investor, what the stock market is, how do you make money investing, what should you invest in, how much money should you invest, and everything else you need to know to get started and build a solid investment strategy to help fund your goals and dreams. So to start on some investing myths. The first one is that it's only for those who are already wealthy. Now, a lot of us will self-select ourselves outside of investing because we don't think investing is for us. But the truth is that you don't need a lot of money to get started. And investing can not only help you protect wealth that you already have, but it's a really critical piece of building your wealth. Second myth is that it's a get rich quick solution. Now, this could not be farther from the truth. Responsible investing is a get rich slow solution. It takes years or even decades before it really starts to make a difference. So any day I would rather have moderate, consistent returns over decades than a year or two of choosing the right stock or the right cryptocurrency that is going to make me loads of money. Because the real magic in investing happens when we leave it to why that's the you're too young or too old to start. The younger you are, the better, but it is never too late. Number 4, it's too time consuming. I really like this quote, which is investing is 99% watching paint dry and 1% full blown panic. And it's what you do in that moment of panic that will determine your returns and how successful you are. So it's really important to put in a little bit of time up front to set a good strategy, to learn the basics, to learn the foundations. But then after that, it's pretty much hands off. I even read somewhere that the best investment strategy is forgetting the password to your brokerage account so that you can't go in and change your strategy and panic sell and make bad decisions in the moment. We'll talk more about why that is and why that's important. Number 5 is that it's too risky. The truth is that sometimes keeping cash is even riskier than investing. Now, investing can be incredibly risky, don't get me wrong, especially if you're not well informed, but it can also be prudent and relatively safe. And then number 6, and this is one of my favorites and something that a lot of people, it's a really big misconception, something that a lot of people get wrong, but you really do not have to be good at picking stocks in order to be a successful investor. In fact, active management or stock picking, people who manage money on behalf of other people for their jobs, so what I used to do in my previous life, the truth is that it doesn't work more than 90% of the time, which is crazy. And when they say doesn't work, what that means is that the investors fail to beat their benchmark index over a long period of time. So they might outperform in the short term, maybe in a couple of months, a couple of years. But if we look at 10, 15-year periods, they'd actually been better off not doing anything at all, which is quite crazy. And I'll get into what the alternative is a little bit later. So why should you invest? There's 2 ways of generating money. Actively, when we exchange time for compensation, when you have a job, pretty much, or passively, where you use your money or existing assets to make even more money. This is things like dividend income when you invest in stocks, real estate income, or pretty much anything that doesn't require you to physically be doing something in exchange for compensation. Now, when you get into retirement, most people are going to be funding their later retirement years or when they're not working through a combination of passive income and capital distributions. Basically a fancy word for using money you've already saved. When you use money that you already have, obviously that is going to go down. So the more passive income that you have, the better off you're going to be. And investing allows you to unlock the magic of passive income. It also allows you to grow your wealth and achieve financial independence, fund your future dreams, and beat inflation and access the explosive growth powers of compound interest. So I'm going to talk a little bit about these last 2 because they're the more mathematical ones that we can dig into and give a really solid case for investing. So inflation is a hot topic right now. It's really, really high. And we know that that means that things are getting more expensive, right? We see these articles all the time about how high inflation is right now, how rents are getting more expensive, how things at the grocery store, gas, all of these things in our lives are getting more expensive. But what's not talked about as frequently, but equally, if not more important, is how inflation is impacting the cash that's sitting in your bank account. This is a fun little graphic that shows it is slowly eating away at the value. Because if your money isn't growing, but everything else is getting more expensive, that money is going to be worth less tomorrow than it is today with inflation at its more like normal rates, which tends to hover around like 3%. Now it's closer to 10. So now your money is going to be losing value even faster. When I say losing value, what I mean is losing purchasing power. So you're not able to buy the same amount of things tomorrow with the same amount of money today. And here is a little mathematical example so you can see in real time how this is going to impact you over the long term. So let's say you start with $100 today. And by the way, this assumes 3% inflation, which is a very long-term average. Right now, it's a lot higher. So this is even a little bit conservative. After 5 years, that $100 are only going to be able to buy you $89 worth of goods and services. But after 30 years, that goes down to 40%. So your money has lost more than half of its value when it's just sitting in a savings account. So investing your money will protect you from inflation. And the theory there is that you're hopefully earning a higher return than inflation, which means that your money is growing or at the bare minimum, keeping its value. So if the return that you were earning was equal to the rate of inflation, your purchasing power would stay exactly the same. Now, the goal is to earn a higher return than the rate of inflation. So not only are you then keeping your purchasing power and you can buy the same amount and the same quality of things today than you would be able to tomorrow, but that amount is growing even faster, meaning your savings are going to be worth way more if you invest them. And this is often referred to as the real rate of return. The rate of return, so how much money you're making on your cash when you invest it before inflation, is usually referred to as nominal. So your rate of return less the rate of inflation is your real return. So what you're actually earning or losing. And now compound interest, one of my favorites and very often not, I don't want to say understood, but it's very difficult for us as human beings to conceptualize the sheer power of compound interest. So if you don't mind dropping into the chat or just thinking to yourselves, a little poll. Which of the below would you rather? A penny that doubles in value every single day for 30 days. So today I give you a penny, it's going to double in value every day for the next month. Or $100 every day for the next 30 days. So instead of giving you a penny today, I'll give you $100 every single day for the next month. I'm not sure if this Q&A should work. So let's see. Does anyone want to take a stab at it in the chat? Trick question, if any. But I know, yeah. So yeah, it's definitely a trick question. A lot of people say 100 every day because obviously that sounds great. So the truth is that you'd actually rather that penny. And the reason behind that is because of compound interest. So if I give you 100 every day for 30 days, by the end of it, you'll have $3,000. But with the penny, you're going to have about $5 million, just over $5 million. And the reason behind that is because, yeah, exactly, the compound interest calculations. So, oops, sorry about that. You can see that the first day you only make a penny. Second day you make 2 pennies. But then by the 29th day, it's doubling in value. So it's kind of like if you've ever heard, there's like an MBA question somewhere about like a lily pad, how long does it take to fill the pond? It's the same theory here. Now, you're not going to invest your money anywhere that's going to double an amount every single day. But when we expand this kind of theory over years and years and years, you can see why compound interest is such a big deal. Tapping into the powers of compound interest can turbocharge your investment growth and get you one step closer to your dreams. So this is the math behind how it actually works. If you start with $10 and you earn a 10%, you'll earn $1, have 11. The next time it compounds or you earn a return or pay interest, then it's going to be based off of that higher balance, not your initial balance. And this keeps going. So compound interest is interest on interest on interest. It grows exponentially. And we can either pay it when we have debt or earn it by investing, which is why if you go back to the 3 rules I brought up at the beginning, paying off debt is the number 2 rule. Because if you're saving your money, but you haven't paid off your debt, it's growing exponentially because of compound interest. And so your savings are really, they're dwindling, they're going down, even though you think it feels like you're saving money. So here is an example that shows you what would happen over 30 years if you just saved $100 per month versus if you would have invested that $100 per month. And this is assuming a 10% annual growth rate, which is consistent with the long-term annual growth of the total US stock market. So a pretty reasonable number for us to look at, assuming you would have just put your money in the total US stock market. If that's over your head right now, don't worry, I'm going to get into it in a little bit. But you can see how at the beginning, the difference, I mean, it's still clear, but it's not as dramatic. The further out you get, the more dramatic the difference gets. And then here's when we layer in inflation, because remember I told you that money sitting in a cash account, cash savings account, is actually going to be losing value every year. So if you would have contributed a little bit over $36,000 over the course of 30 years, that at the end of 30 years would be worth $24,000. But if you would have invested it, you're sitting on over 100K, even though you only contributed 36. Pretty big deal. And this is why investing is so critical for long-term wealth creation. So now that we've talked about why it's incredibly important to invest, because it gives your money superpowers over the long term and helps you become rich, let's talk about what steps you have to take to actually invest. So the first one is determine how much money you want to keep in cash and how much you're actually going to invest. Now, I know I said that cash loses value over time, but investing does carry some level of risk. So the value might go up, the value might go down. So investing all of your money could be risky. You always want to keep a little bit in cash. Step 2 is open a brokerage account, which is what allows you to access the stock market. Then figure out what to invest in and make a plan. So having a plan on day 1 will help protect you in the future when you're not sure if something happens, you don't know what to do, you might get emotional if you start seeing the value of your investments go down. Stick to your plan. And then set your plan into action. So as I mentioned at the beginning, we have loads of masterclasses on the app that breaks all of this stuff down. So I'm going to get in as much detail as I can for the next 20-ish minutes. But if you want more or anything doesn't make sense or you're really interested in this, there is so much more information than I could possibly provide in 45 minutes on the app. And it's all videos, audios, templates, and more good stuff. So now let's talk about how to figure out what to invest in, which is probably one of the most difficult parts. So today we're going to talk about the stock market, which is the most accessible entry point for investing for most of us. So the history of the stock market actually dates back to Amsterdam in the early 1600s. The original Dutch explorers wanted to go explore new lands, but they didn't have enough money to fund the expedition on their own. So they went to the public knowing that people would be interested in helping and said, hey guys, does anyone want to give us some money to fund this expedition? And then we'll give you a percentage of whatever profits that we find abroad. Public agreed, And so with that, the first publicly traded company was born, which is the Dutch East India Company. Today, you no longer have to go to one place and you no longer need to invest in one single company. It's an electronic exchange where companies go to raise money. They can do that by issuing debt or selling equity. Debt is also called bonds, and that is when companies are borrowing money from investors. Governments can also issue bonds and borrow money from the public. Equity is ownership or share or stocks. They all mean the same thing. So when you buy one single stock of a company, you're buying a very small piece of ownership of that company. So when you go on Yahoo Finance or Google or read the Wall Street Journal and it says Amazon is trading at whatever value, what does that actually mean? That's the share price, which is calculated by allocating the total value of a company between everyone who owns the company, all of the shareholders. You're splitting up the pie. So if you think about the value of a company like a pizza, if this pizza costs $10 and two people own it, there's two shares available to purchase, there's two shareholders, two owners, then each share would cost $5. If you divide it again, $2.50, and so on and so on. In the stock market, companies have millions and millions and millions of shares outstanding, meaning there are millions of fractional little pieces of ownership. And how much of the company you own is determined by how many shares you own divided by all of the shares that are available to trade. So when you buy a share, how do you actually make money? Now, the first and the obvious way is when the share price increases in value. There's two different ways to think about it here. Either realized, meaning after you buy a stock, it increases in value, you sell it, you pocket that difference, you've made however much money. That value is realized, you've crystallized it. If it goes up, then that's not your problem. Same thing if it goes down. But then there's unrealized. And this is really important because people say all the time, I lost X amount of dollars in the stock market today. And unless you actually sell your investments, you haven't lost money. So if you own shares and the value goes up or it goes down, but you don't sell, that's considered an unrealized gain or an unrealized loss. And there's a potential for it to keep going down farther and never come back up, or there's a potential for it to go back to continue increasing. The other way is through something called dividends. I referred to dividends earlier when we were talking about passive income. When you own a stock, cash is paid if the company pays dividends. Not all companies do, but if a company pays dividends, then cash will be deposited into your account as a thank you payment for being an investor roughly every 3 months. So dividends are usually paid quarterly, and companies can choose to stop paying them at any point, or they can reduce them, they can increase them. They're not contractual. When you own a bond, and I'm not going to get too deep into bonds today, but when you own a bond, they pay coupons, which are similar mechanically to dividends. You're going to get that money in your account every quarter, but they are contractual. So for that reason, they're a little bit less risky. The returns tend to be a little bit lower. And then the last way is via compound interest or compounding returns. And this is the example that I gave you earlier. The longer you hold something, let's say you own a stock, it increases in value 10% this year. Next year, if it increases 10%, it's going to increase 10% off of that higher value. So you still own the same number of stocks, but the value is going to increase on a curve kind of exponentially, which is important. One quick tip here, and this is really, really important. Someone watched this webinar last month who called me later and they were like, I consider myself to be a really savvy investor. I agreed with everything that you said. I've studied this my whole life. And then I went into my brokerage account and I realized my dividends weren't reinvested. Bad news. and reinvest your dividends if you can, because that will turbocharge your growth from compounding. And it's literally just a setting in your brokerage account. So this is super, super important. Let me just see a quick question here. So does that mean as long as I don't sell my invested money, the amount of money I'm not lost, I can sell my same? Okay, that is a really good question. No, you cannot sell the same amount that you originally invested after the stock went down. So if you were to sell at that moment, you would lose money, which is why panic selling or selling when a stock goes down and you get scared is one of the worst things that you can do, because you're crystallizing that loss. What you can do is wait for the value to go back up. Now, when you're invested in something risky or an individual company that maybe you're not sure if it's going to ever recover, then you might want to sell to cap your losses. And you say, I'm out, kind of like at a casino, right? If your money starts going down and you say, ooh, I'm nervous, I'm not going to get back up, let me get out before I lose anything else, that's when you should sell. But if you're invested in something where you believe in the long-term fundamentals of it, and there are different things that you can invest in, like the total US stock market that historically has always recovered, then it's usually a better idea to stay invested and wait for the economy to recover than to panic sell when it goes down. But no, once you invest your money, that you're basically buying at a given point in time at that price. So you can only sell for whatever happens to that price in the future. All right. Let's see. Next slide. So what can you invest in? And this is a good segue because I've kind of touched upon a couple of these points. You can invest in stocks and bonds, which we've discussed. Stocks are like ownership. If you buy a stock of a company, you become a part owner, you own a tiny little piece of that company. If the company does well, you do well. If the company does poorly, you do poorly. And when you are invested in stocks, you might get dividends if that company pays you dividends, and that's a form of passive income. Bonds is when you lend money to a company. I know it's not intuitive to think that you buy a bond and you're lending money. It is confusing. It's just took me a long time to be able to kind of put that together in my head, but think of it as you're buying like a physical IOU. So then you can buy individual stocks like Apple or Tesla or Zoom or any other individual company. But you can also buy funds, and a fund can be active, meaning it's someone's job to pick a number of investments that you will then buy a stake into that whole thing, kind of like buying a fruit basket instead of buying the individual fruit, or a passive fund. And then you can also, which I'll talk about in a second, or you can also invest in alternative investments. Alternative investments are things like cryptocurrency, NFTs, art, hedge funds, which are usually out of reach for most of us, for most retail investors, which is what individuals are. And then property is technically considered an alternative investment, but I'm just gonna kind of leave that there for now. Passive funds are my favorite way to invest, and for most people are the best way to get broad exposure to the stock markets. So how do we make sense of all of this? Because it's a lot. Figuring out what to invest in is probably one of the hardest parts. There's so many different options. There's so many things getting thrown at you. So when it comes to individual stocks, we talked a little bit at the beginning, the investing myth that you don't have to be good at picking stocks to be a successful investor. And here's why. Stock picking is really, really difficult to get right consistently. And investing in individual stocks is really risky. If you look at a 20-year period, 94% of active managers failed to beat their benchmark index. Benchmark index, they basically look at a passive index, which I'll talk about in a second, and say, we want to make a return higher than that. Only 5% of them are able to. And this is people who do this for a living. This is people who spend the majority of their waking hours stock picking, analyzing companies, talking to people in the know, and they still get it wrong. So to think that as an individual investor, we have any chance at all of getting it right consistently is crazy, because it's just really, really hard. But it doesn't mean that you have to avoid it completely. The holy grail of risk reduction is called diversification, or not putting all of your eggs in one basket. And the theory here is that when you own a little bit of everything, you don't have to guess which stock is going to go up, which one's going to go down, and which one is going to make you money. Rather, you're exposed to the broader economy and broader market movements if you own a little bit of the entire stock market. And you can do that via funds, particularly passive funds. So funds are diversified baskets of securities and give you instant diversification. So instead of you having to sit there and create a portfolio of hundreds of stocks, you can just invest into one fund, which acts the same way as investing in a stock. You basically go on your brokerage account and buy one share of the fund, and you're getting access to loads of companies and instant diversification. You might have heard of index funds or ETFs, and funds can be actively or passively managed. When they're actively managed, what that means is that it's someone's job to do the stock picking. Passively managed funds means that it takes a broader index, so something like the total US economy, the S&P 500, which is 500 of the largest companies in the US. If you're in the UK, the FTSE, the NASDAQ, other broad indices, and a computer automatically creates a portfolio that has exposure to all of these companies. So, and that's going to be updated kind of behind the scenes, and everything is done automatically. So not only are you then getting super broad exposure, but you can also pick what you want to invest in. So let's say you want to invest in the total US economy, you can do that. Let's say you think tech is going to do really well and you want exposure to tech. You can invest in a passive fund that only invests in technology stocks. Let's say you want emerging markets. Let's say you want impact investing, ESG focus. You have options for that. Let's say you want to invest in a passive fund that buys bonds or maybe just equities or shares. You have options. So passive funds give you instant diversification. You do have to pay a fee when you invest in funds. Active funds or hiring a financial advisor to do this for you can be as high as 1%, which really, I know it doesn't sound like a lot, but it really eats into your returns over time in a really significant way. But passive funds charge as low as 0.03%, and that's why they're often referred to as low-cost index funds. One of the most popular and my favorite is the S&P 500, or if you just do like a total US market index fund, you're getting very broad exposure. So this is the return of the S&P 500 over since the late 80s. If we were to extend this graph, it's averaged about 10% annually. Now, this isn't to say that there are periods where it's going to drop. This year, it's down about 15% so far. As you can see here, this is 08-09. It was down for a period of about 4 years, but then eventually it recovered. When you invest in something like the total US stock market, the total UK market, or Europe, these kind of very, very broad exposure funds, especially in the US, over time, economies get more advanced, economies get better, people get better at their jobs, and the stock market tends to go up. So even if there are periods where it's down, like today, like 08, like the COVID pandemic, it always has recovered historically. Now, no one knows what's going to happen in the future, but most experts agree that over the long term, it's still a very solid bet. For you to have an idea, Warren Buffett wrote into his will that when he dies, he wants 90% of his wife's assets invested into the S&P 500. And a lot of really famous and well-respected investors also have similar views to this. So just this quick graph, and then I will open it up for questions in a minute. that to remind us that failure, and especially news headlines, is the frame, not the whole picture. So right now, yes, the S&P 500 is down a little bit. The total US stock market is down. But when we look at a broader picture of decades instead of months or years, you see a trend. So it's important to zoom out and say, what did I invest at? What are my long-term goals? How long can I stay invested? Oops. And then this graph that I also quite love that shows you the likelihood over the past 100 years, if you would have invested into a total US stock market, the probability that you would have lost money. So if you would have stayed invested over 20 years for any period over the past 100 years, there's a 0.1% chance for you to actually lose money. And that's if you would have invested in something like 1906 and sold in 1926, right in the middle of the stock, or right, I forget the exact combination, but it was somewhere around the stock market crash of the 20s. So literally one combination of dates just helps to put it into perspective. So I'm going to just quickly go through these slides. So this is how much money should you invest for how long. We talked about the importance of long-term investing to give money, your money time. If it does the stock market does drop off a little, it's for it to go back up and not panic sell and risk losing your money. For that same reason, your emergency fund, i.e. money that you need in the short term, usually recommended as 3 to 6 months of expenses, should always be kept in cash, but any other long-term savings should be invested either into the stock market or some less risky securities like bonds. And then always pay off high interest rate debt, usually in the double digits, before investing. A rule of thumb is that if you're paying a higher percent interest rate on your debt than you would make in investings, then you should pay off your debt first. And remember that time in the market beats timing the market. None of us have a crystal ball. It's impossible to know what will happen to the stock market next month or even next year. But if you invest for the long term, the chances of success are much higher. Here is a quick next steps of what else you need to know to get started. Here are a couple of modules that are available on Finasana's app and website that break everything down further. Highly, highly recommend. And then as promised, here is a 50% off discount code that is working for that will be working for the next 24 hours. If you want to check out the app, on top of this discount code, everyone gets a 7-day free trial. So download it, watch a couple of videos. They're all under 5 minutes long, and they break everything down step by step for everything that you need to know. And with that, I will open it up for questions. It looks like there's a hand up. Let's see. It might be easier to just drop them into the Q&A or into the chat if anyone has any questions. I see one question here. So what would be the time frame to exit a stock? So generally speaking, the longer you have to leave your money invested, the better. So when you invest, usually it's for kind of decades, right? You're thinking about your retirement in the future. So it's usually recommended, again, this is if you're investing in things that you're comfortable with their long-term fundamentals, is getting into a schedule of investing a certain amount every month, every year, whatever it is. And then when you hit retirement and you need to take money out to fuel your expenses, you do the opposite. So you have a schedule that you'll plan on selling regardless of the market being up or being down. And the idea is that it then averages out. But obviously, if you're in the middle of a crash and you have enough cash on hand to avoid selling your investments, even at that point, then that's probably better. But at that point, your money would have been invested for so long that even if the stock market has taken a dip, you probably still would be up on the investment because it's been such a long time. Now, if you invested in something that is much riskier, if you took a bet on a stock, a single company stock, because you think it's going to outperform, you think it's the future, it's doing super well, then I would recommend in selling once it's hit kind of the price ceiling that you set. So you can say, I think this is going to go up to $100. Once it hits that, I'm going to crystallize my returns so that I don't have any risk of it continuing to go down in value. Generally speaking, though, holding on long term tends to be better. How much would I need to invest to be getting decent dividends to live on? This is a hard question, and it really depends on your specific situation, how much you want to spend in retirement, and how much money you have saved up in total, whether you're planning on kind of taking capital distributions. There's some studies done recently that suggest that in retirement, you should have somewhere between $1 to $2 million. That doesn't mean you have to invest that much money by any means, because remember, the more consistent you are with kind of drip feeding your investments throughout your life, the more compound interest is going to work. On US stocks, so like the S&P 500, it pays a dividend of about 1 to 2% of the total amount that is invested. So that can be kind of a good starting point to just think about, well, if I want to have, I don't know, $50,000 a year in retirement, then how much do I need to have invested in order for that to be that 1%? Let's see, do we provide corporate services or workshops? We most definitely do. If you're interested in bringing a workshop to your employees or any associations that you're involved with, definitely get in touch. We have a whole library of workshops that we provide, and they're usually much longer than 45 minutes, so we can go a lot more in depth. When you go to invest, what do you suggest to start? Schwab, Robinhood, TD Ameritrade, a good starting point. So when you start investing, you should look for a brokerage account like one of these that you mentioned. Now, it really doesn't matter where you open a brokerage account as long as it gives you access to the types of things you want to invest in. So what I mean by that is some brokerage accounts will only let you invest in single stock securities, meaning individual stocks. Other will give you access to funds. Some will only give you access to their funds. So like Vanguard is one that usually you can only invest in Vanguard funds when you go through Vanguard, which honestly isn't the worst thing in the world. But it's just knowing what you're getting access to, kind of like picking a mall to go shopping at. The other things to consider are whether they're going to charge you any fees to hold your money. So just like opening up a savings account, you want to look for the lowest fees. And then the last thing to consider is whether they're charging you each time you make a trade. So again, the lower the fees, the better. And a good starting point, honestly, 1,000 is great, 5,000 is great, $50 is great. Whatever you can afford, whatever you can fit into your budget. I always say that even if you're starting with 20 bucks, it's better to just start. Put $20 away every month if you can. Just get started. Also, because when you have greater amounts to invest, then you'll already be comfortable with it. You'll know a little bit more, and you'll have that experience with lower amounts. So you'll feel more confident with bigger amounts. Okay, did I answer that or any more? I think we're just a little bit over. We're about 5 minutes over. So does Finasana show me how to invest step by step, how to open an account? Yes, it does. We break everything down into everything you need to consider. So like literally how to open a brokerage account, what you need to get started, what you need to look for. Once you open that brokerage account, all of the different options that you get on the website, which can be a little confusing. We'll break it all down for you. And when you sign up for Finasana, the premium membership gives you access to Ask Finasana totally for free. You get unlimited questions, so you can send in any questions you have or book a one-to-one coaching call with us. All right, thank you so much everyone for joining. We'll be sending out a recording and also a survey for feedback. So would really mean a lot to us and would be really helpful if you could fill that out and send over any feedback that you have. Have an amazing rest of your day, everybody.